Bring it all together. You now know how to read charts, track sentiment, and follow fundamentals, but trading success comes from combining all three into one clear view. In this lesson, you'll learn how to do exactly that, step by step. No single data source tells the whole story. Fundamentals explain the why, sentiment shows the how, and technicals help you time entries and exits. Together, they offer clarity. Start by checking key fundamental drivers: earnings, macro news, economic releases. These set the stage for sentiment shifts and price behavior. Use sentiment tools like COT, Fear and Greed Index. Look for emotional extremes. These often hint at turning points. Use chart patterns, indicators, support and resistance, and trend lines. Technicals help you confirm when fundamentals and sentiment line up. Combine fundamentals plus sentiment plus technicals before placing a trade. When all align, your conviction and edge increase significantly. Now let's walk through a real-world scenario and combine them to make a smart trading decision. Time for a quick quiz. Voyager Technologies just had a strong IPO. It raised $400 million and attracted high investor interest, signaling confidence in the commercial space sector. What kind of fundamental trigger is this? Neutral, average performance. Bearish, weak capital raise. Bullish, high demand, strong capital injection.
Yes, you're right.
Well done. A strong IPO backed by investor enthusiasm and capital injection is a bullish fundamental signal. It reflects market confidence in the company's future. Time for a quick quiz. Social media and news are optimistic, and the Fear and Greed Index is at 70, signaling greed, but not yet extreme. What does greed-level sentiment often signal? A buying opportunity without risk. A healthy long-term uptrend. A possible short-term reversal or overheated conditions.
Yes, you're right.
Correct. Greed suggests optimism, but it may also hint that price has moved too fast. Caution is wise. Look for confirmation. Time for a quick quiz. Voyager surged early in the session but met resistance near $60. It pulled back, found support around $55, and then rebounded with higher volume. It's now hovering near $57. What does this price action most likely indicate? Neutral zone, avoid until clearer pattern. A reversal is confirmed, short now. A potential bullish continuation if it breaks above $57. 50.
Yes, you're right.
Good eye. The recovery on strong volume hints at bullish interest, but you should wait for a breakout above $57. 50 to confirm continuation. Voyager's setup shows how combining fundamentals, sentiment, and technicals leads to smarter trade decisions. Fundamentals are bullish. Sentiment shows greed. Technicals suggest bullish potential. While the setup is promising, it's not time to act yet. Waiting for confirmation keeps your edge intact and avoids emotional entries. You've now analyzed Voyager's fundamental strength, rising sentiment, and a potential technical breakout. When all three elements support each other, you have a strong case for action. But what happens when they don't align? When all three signals align, you can act with high confidence. This alignment provides strong conviction and increases your edge in the trade. When one signal is missing or unclear, be cautious. Wait for confirmation or reduce your position size. Partial alignment means the setup has potential, but the risk is higher. When signals conflict, avoid the trade or manage your risk very tightly. Conflicting data creates uncertainty and lowers the probability of success. Knowledge check. Match the setup with the right action. Match each market condition with the appropriate decision. Consider the clarity of signals from fundamentals, sentiment, and technicals. You've learned how to combine fundamentals, sentiment, and technicals into a clear market view, but timing still matters. In the next lesson, we'll explore how to act on that view, whether it's before a big event, after news breaks, or when markets are quiet. Timing is everything. Your multi-source analysis gives you clarity, but trading success depends on when you execute. In this lesson, we'll explore how to time your trades, before events, after news, and in quiet market conditions. Even a perfect setup can fail if you enter too early or too late. Timing determines whether you catch a trend early or get trapped in noise. That's why traders plan entries around specific event zones. We'll focus on two timing strategies: pre-event setups and post-event reactions. These zones help you anticipate or confirm opportunities. Pre-event setups happen when price consolidates before a big release, like earnings or CPI. If fundamentals and sentiment align, this zone offers a potential edge. Many traders avoid pre-event trades due to uncertainty, but if the setup is clear and risk is controlled, pre-positioning can offer strong reward to risk. Look for chart structures like flags, triangles, or squeezes before key events. These patterns often signal compression before a breakout. Time for a quick quiz. A triangle is forming just before the company's earnings release. Fundamentals are bullish, sentiment is neutral. What's the best decision at this stage? Wait for a confirmed breakout after earnings. Go short in case of surprise news. Ignore the setup due to neutral sentiment. Enter early to catch the breakout.
Yes, you're right.
Good choice. Neutral sentiment means the crowd isn't convinced yet. Waiting for a post-news breakout adds confirmation and reduces risk. Post-event trades occur after volatility hits. You use the initial market reaction to confirm your bias. These trades are safer, but sometimes late. Wait 15-30 minutes after major news for direction to settle. Let the market react emotionally first, then you follow with a logic-based entry. Post-event entries rely on confirmation. If price breaks a key level with strong volume and aligns with your analysis, it's a valid opportunity, even if you miss the initial move. But beware of fake-outs. After the news, the price may break out, then snap back. That's why waiting for retests or volume confirmation is key. Time for a quick quiz. A company's earnings beat expectations. After the announcement, the price surged past resistance at $62, but now it's pulling back slightly. Volume is high. What's your best move now? Wait for retest and bullish candle. Fade the move. Go short. Skip it. Too late to enter. Enter immediately. Breakout confirmed.
Yes, you're right.
Smart move. Let the price retest the breakout zone and confirm with price action. This way, you're not chasing and still trading with the trend. Now let's talk about dead zones. Times of day or week when price is choppy, volume is low, and signals are unreliable. Common market dead zones include midday from 11 a.m. to 2 p.m. Eastern Time, Friday afternoons, and holiday sessions. During these periods, trading volume and volatility often drop. It's best to avoid new trades unless a setup is extremely clear. During dead zones, focus on reviewing past trades, journaling, or preparing for upcoming sessions. Patience is part of good timing. In short, pre-event, good for proactive traders with clear setups. Post-event, safer but may miss the best price. Dead zones, best avoided. Match the timing approach to its description. Think about when each is used and how it affects risk. Great timing is about clarity, confirmation, and control. But not all market moves are what they seem. In the next lesson, you'll learn how to avoid hype traps and emotional fakeouts by trading only confirmed, high-quality signals. Drama doesn't trade. Markets often move fast after headlines, but not always in the direction you'd expect. In this lesson, we'll explore how overreactions happen, how to recognize them, and how to respond with discipline instead of emotion. Overreactions happen when traders react emotionally, not logically. This leads to fake-outs, moves that break key levels but don't hold. Fake-outs are common after news events. A breakout looks real, then fails. Smart traders wait for the second move to confirm. Hype traps are driven by media and crowd buzz. Stocks skyrocket on headlines, then crash when reality kicks in. Avoid buying at emotional extremes. Use sentiment tools, volume analysis, and chart confirmation. Emotions fade, but price action remains. Warning signs of a fake-out. A sharp candle breaks the key level, but volume is low. Immediate reversal back below the breakout point. No follow-through in next candles. Momentum stalls quickly. Remember that a breakout is real when price breaks a level with strong volume and keeps moving. A fake-out happens when price briefly moves past a level but quickly reverses, often on weak volume. Time for a quick quiz. Price breaks above resistance, but volume remains flat and RSI is overbought. Based on this, what is most likely happening? Clean breakout. Fake-out. Healthy pullback. Reversal confirmed.
Yes, you're right.
Excellent. Low volume and overbought RSI suggest the move lacks strength. Without confirmation, it's likely a false breakout. Overreaction isn't just upside. Panic sell-offs can also reverse quickly. Be careful not to sell into fear without confirmation. Time for a quick quiz. Stock crashes 15% on earnings miss, but quickly forms a doji on support. Volume is fading. What would be the best course of action? Short it now. Wait for breakdown. Watch for a bounce.
Yes, you're right.
Well done. A doji at support after a sharp decline and fading volume suggests a possible bounce or fake-out trap for late sellers. Wait for bullish confirmation. Use indicators to detect potential traps. RSI divergence can warn of weakening momentum. MACD fading signals loss of strength behind a move. Lower highs after a breakout often confirm a failed rally. Journaling fakeouts helps you spot patterns. Note what happened, how price behaved, and how you reacted. This builds emotional control. Knowledge check. Signs of a potential trap. Select all the signs that warn of a false breakout or fake-out. Let's recap. Overreactions are common. Don't trade hype or fear, always wait for confirmation. Fake-outs can be avoided with patience. You've just learned how to spot overreactions, avoid fake-outs, and stay clear of emotional traps. The key is to stay disciplined, wait for confirmation, and trade with logic, not hype. Next up, let's put your skills to the test with a short quiz.
What's the best course of action when all three signals, fundamentals, sentiment, and technicals, align? Avoid the trade to minimize risk. Reduce position size just in case. Wait until sentiment calms down. Act with confidence. All systems support the trade. Amazing. A company reports strong earnings. Sentiment is greedy, but the price hits resistance and stalls. What should you do? Wait for a confirmed breakout before entering. Ignore it. Strong earnings always mean buy. Go short. Reversal is guaranteed. Enter immediately to catch the breakout. Two. What's the primary risk of trading during dead zones? High volatility increases stopouts. Low volume and choppy price action lead to unreliable signals. Spread costs go down. Too much news at once causes confusion. 3. In a hype-driven rally, price breaks resistance on low volume and RSI is overbought. What's the likely scenario? Reversal confirmed. Go short. Clean breakout with continuation. Time to buy more aggressively. Fakiyat. Weak confirmation and emotional drive. Four. Price drops 15% after an earnings miss but forms a doji on support with fading volume. What's the safest move? Chase the move down with a sell order. Watch for a bounce and wait for confirmation. Enter a short immediately. Go long now without confirmation. 5 in a row. What does a pre-event triangle pattern suggest when fundamentals are bullish and sentiment is neutral? Short immediately in case of bad news. Wait for breakout confirmation post-event. Buy early before the crowd. Skip the trade entirely. Too unclear. 6. Which of the following is not a sign of a fakiyat? No follow-through after breakout. Strong breakout volume and higher highs. RSI divergence. Low volume breakout. 7. What does the wait rule suggest during fast, emotional price moves? Increase position size for better gains. Pause and check confirmation before acting. Place a market order immediately. Jump in quickly before the move fades. 8. Post-event price breaks resistance on high volume, then slightly pulls back. What should a patient trader do? Avoid the trade. It's too late. Wait for a retest and bullish candle confirmation. Enter the trade immediately. Breakout confirmed. Go short. It's a top. 9. Why should traders combine fundamentals, sentiment, and technicals? It provides a clearer, higher confidence view of the market. It allows you to predict news before it happens. It guarantees a winning trade. It helps reduce trading fees.